Okay, welcome back to the deep dive. If you've had your eye on, well, basically anything to do with money or housing in Canada lately, you know why we're here today. We are digging into something pretty significant. The Bank of Canada just cut rates again, down to 2.25%. Now, that sounds like simple good news, right? A bit of relief. But the analysis we're looking at from market experts and even some internal notes, it paints a more, let's say, complicated picture. So this deep dive, it's really our way of figuring out this double message for you, buyer, seller, investor, whoever you are in this market. Okay, let's unpack this.
Yeah, the double message is absolutely the heart of it. The Bank of Canada, they've given us what our sources are calling, another dose of borrowing relief. Helpful, sure. But, and this is the really crucial bit, they also strongly hinted that this cut, this 2.25%, well, it might just be the last one, the end of the easing cycle.
Okay, maybe just quickly clarify easing cycle for everyone.
Yeah, right, good point. So the easing cycle is just that period when the central bank is deliberately cutting interest rates, trying to give the economy a boost. If they're saying that's over, it basically means this trend of money getting cheaper and cheaper to borrow. Well, that ride might be stopping. So our mission today is to really explore that tension, relief right now, but caution about what comes next, and specifically how that changes things for housing, especially around the GTA, and for investment plays.
Let's definitely start with affordability. I mean,
Right.
that's been the number one headache for so many Canadians, right? This lower rate, psychologically, it feels like a big deal. It must give some breathing room to people with variable mortgages, and maybe it tempts some buyers who've just been waiting for anything, really.
Oh, absolutely. And we can actually put some numbers on that immediate financial bit. Affordability, it's been this massive wall for, what, the last 18 months? Especially in the big cities, Toronto, Brampton, Mississauga, you name it. Our analysis shows that every little quarter-point drop like this one, it does give back some of that buying power people lost when rates were soaring.
Okay, so how much buying power are we talking?
Well, think about it like this. Maybe a family, they got pre-approved, but they were capped at, say, $800,000, purely because of the high interest costs. Now, with this rate cut, the monthly payments on a loan are slightly lower. So maybe, just maybe, they can now stretch to $830,000, perhaps a little more.
Okay, $30,000 more. That's something for that specific family, definitely. But let me push back a bit here. In markets where detached homes are, way over $1 million, does that extra 30K really solve the deep affordability problem? Or is it just kind of nudging the demand up a tiny bit?
That's exactly the right question to ask.
Yeah.
No, that $30,000, while it helps that one buyer, it's obviously not fixing the whole systemic issue overnight. But here's why the bank's caution is so important now. If they're serious, if this really is the end of the easing cycle, then this little improvement in affordability we're seeing, it might be temporary. The window is limited.
Ah, okay. So if you're a buyer thinking, maybe I'll wait for one more cut.
You could miss it. You could miss this moment where rates are relatively low and prices haven't fully responded yet. That's the potential peak affordability point.
Because if rates just stay flat from here, eventually demand picks up more, supply stays tight, and prices just climb back up, eating away at that game.
Precisely. If the bank holds steady now, this moment, lower rates, plus some price stability might be the best it gets for affordability for a while, not later.
Right. Which leads us straight into market sentiment, doesn't it? That psychological element, the fear that kept buyers frozen. What if I buy now and rates drop again? It's maybe lifting a bit.
Yeah, confidence is definitely getting a boost. You can feel it. That uncertainty was paralyzing. Now buyers have a bit more financial room, and maybe the feeling that rates aren't going to plummet further. They're tired of being on the sidelines. This cut, it's like the permission slip they felt they needed.
And where do we expect to see the action heat up first? The analysis seems to point towards entry-level buyers finally making a move and also families looking to trade up, specifically mentioning places like, family areas in Peel Region and Halton.
That's where the data points, yes. But, and this is really key for anyone listening, this wave of optimism, it's not going to hit everywhere the same way. It's not uniform. You'll likely see demand pick up faster in the core urban areas and those main commuter zones where the job market is strongest.
Okay, so not everywhere gets the same bump.
Exactly. Remember those more rural spots or distant suburbs? The ones that saw those absolutely massive price jumps during the whole work-from-home frenzy? Yeah, those areas, they might just see prices stabilize, maybe some modest growth, but probably not a sharp V-shaped recovery. They had further to fall, in a sense. The excitement won't be evenly spread.
Okay, that makes sense. So buyers are feeling a bit better, acting on it. What about the other side, the sellers? If demand ticks up, what happens with supply?
Yeah. This is where it gets interesting. It could create this potentially short-lived swing back towards sellers in certain pockets. You get this rate cut, even a small one, combined with buyers feeling more confident.
Mm.
If an area already has very few homes for sale, it could briefly feel like a seller's market again.
But only for certain properties, right?
Yeah, absolutely critical point. The sources are really clear. This isn't going to magically sell poorly maintained or outdated homes for top dollar. This boost really benefits the good stuff. Well-presented, turnkey homes, the ones people can just move into without major work. Those are the properties, especially in areas with tight inventory, that might start seeing multiple offers again.
Thinking places like Caledon, maybe parts of Vaughan, North Brampton,
Yeah,
where listings are already pretty thin on the ground.
exactly those kinds of areas.
Okay, so good news for those sellers, but here's my worry, and it goes back to the Bank of Canada's tightrope walk. Don't we actually need some price growth for a healthy market? If things tip back into bidding wars too fast, isn't the bank just hoping for this perfect, gentle landing, this Goldilocks thing that almost never actually happens in real estate?
You've hit the nail on the head. That Goldilocks scenario is exactly what they're aiming for, but it's incredibly difficult. It really is like landing a plane on a very short runway in tricky weather. They've eased off the throttle a bit with the rate cut, but cut too much, the economy could stall later. Don't cut enough, or cut and then stop, and maybe you overshoot into inflation again if demand heats up too fast.
Especially if supply doesn't show up.
Precisely.
Mm.
The policymakers know this. If this new demand runs smack into the reality of not enough new homes being built, which, let's be honest, isn't changing, overnight prices will accelerate. And that fast price growth, it completely undermines their goal of making housing more affordable in the long run. So they'll be watching like hawks.
Meaning they could step back in if things get too hot.
That's the implicit warning. Their caution signals they're ready to act, maybe not with cuts, but potentially holding firm or even signaling future hikes if the market starts looking frothy again, say by mid-2026.
Okay, let's shift gears a bit. We've talked buyers, sellers. What about investors? The people playing with, let's say, more strategic money, lower borrowing costs must look pretty good to them.
Oh, for sure. On the surface, investors look like the immediate winners here.
Yeah.
Lower rates mean potentially better cash flow, especially if you're dealing with, like, multi-unit buildings or even pre-construction deals locked in earlier.
But I sense a but coming.
There's always a but with the bank's messaging. The but is that signal. The easing cycle may be over. That forces a really fundamental change in investor thinking. The old way, maybe for the last decade or more, was partly based on speculation fueled by ever cheaper money. You'd buy something, assuming your financing costs would likely drop over time, boosting your return. That assumption is probably off the table now.
So no more counting on rate cuts to make the numbers work.
Exactly. Future profits now have to come from solid fundamentals, from the property itself performing well. It's less about speculating on interest rates and more about strategic asset management. Does the rent cover the current stable borrowing costs plus expenses? Does it have genuine appreciation potential?
So what does that look like? What are smart investors focusing on now, according to the analysis?
Yeah, the analysis highlights 3 key areas where savvy investors are putting their attention. First, purpose-built rentals. Think apartment buildings, especially ones near good transit and jobs. Focus is on reliable, steady rent income.
Okay, makes sense.
Consistent demand.
Second, detached houses where you can legally add a basement suite or maybe even a laneway house, maximizing rental income from a single property. They're looking at zoning bylaws as much as neighborhood appeal.
Right, creating more cash flow per asset. And third, carefully chosen suburban developments. Not just any new build, but ones in areas with clear, long-term growth drivers, planned infrastructure, population growth projections. They're avoiding those really speculative pre-con deals that only made sense if rates kept falling.
So they're basically de-risking, planning for rates to stay flat or maybe even edge up eventually rather than banking on them going down further.
That's the core pivot. Protect against rate stagnation or even future hikes.
Taking a step back then to the bigger economic picture, this rate cut, it does signal some confidence from the bank, right? That inflation is finally heading towards that 2% target. It's like saying, okay, the tough medicine worked.
It is a nod to progress, definitely. It acknowledges the pain of the high rates over the last couple of years has had the desired effect, taming inflation. But again with the but, the caution about stopping the cuts is just as important. It shows they're worried about maybe jumpstarting things too much.
Overstimulating demand.
Exactly. They're managing expectations very carefully. They want people to feel some relief, sure, but not to suddenly go out and finance huge speculative ventures, assuming money will stay this cheap or get even cheaper.
Because if the economy takes off too fast,
Inflation could spike again, it could roar back ahead of their target, and if that happens, they could be backed into a corner. They might have to consider, well, raising rates again, maybe as soon as early 2026.
which would be incredibly disruptive, all that stability we thought we were getting, gone.
Utterly destabilizing.
Yeah.
Politically painful, too. So the message, really, is pretty straightforward when you decode it. Enjoy the slightly lower rates now, breathe a little easier, but please do not build your 5-year financial plans around the idea that rates are just going to keep dropping for the next year or two. Stability is the goal now. Overenthusiasm brings back the risk of volatility.
Okay, that's a lot to digest. Temporary relief, but a strong signal for long-term stability, maybe even future volatility risk. Let's bring it home for the listener. In this sort of normalizing economy, what are the concrete takeaways? What should people actually do right now?
Right, let's boil it down to actionable advice based on this outlook of likely rate stability. Okay, first, for buyers, look, the analysis suggests this really might be the sweet spot. Rates are lower than they've been, but the full force of buyer competition probably hasn't kicked in yet. So action item 1, get your pre-approval locked in now. Action item 2, really compare fixed versus variable rates carefully. Given that volatility risk down the road, maybe locking in a fixed rate, even if it's slightly higher today, offers peace of mind against potential hikes in 2026. Waiting could mean facing both higher prices and maybe less favorable rates.
Makes sense. Seize the moment, but hedge your bets. What about sellers?
For sellers, time for an honest look at your property. Is it truly market ready? Modern, clean, priced right? If yes, this environment should treat you well. Buyer purchasing power just got a little boost.
But if it needs work,
If it needs work, the boost might not be enough to overcome buyer hesitation. The days of selling anything with 4 walls for a crazy price are over. But if you have a genuinely attractive move-in ready home, yeah, you should see strong interest. It's back to basics. Quality sells.
okay. And finally, investors.
Investors, go over your spreadsheets again, seriously.
Mm.
Recalculate your cash flows and expected appreciation based on rates staying flat, not falling. The speculative game is up. Your focus has to be on properties that generate solid, reliable income right now, at today's rates. Can the property carry itself if borrowing costs don't decrease for the next 2-3 years? If your whole model depends on another rate cut next year, you need to rethink it urgently.
So recalibrate for stability, that seems to be the theme. This has been really helpful. It feels like this rate cut, it's less about just the number 2.25% and more about signaling a shift, right? Moving away from crisis mode towards, well, something more balanced, which honestly is probably healthier for the real estate market in the long run, even if it feels less exciting than the wild swings we've seen.
I think that's exactly right. It's a pivot. The whole conversation is changing from just when will rates hit rock bottom to how do I build a smart, sustainable position in this new, more stable environment? The opportunities now. They likely belong to people who act decisively but also thoughtfully, who analyze based on the stability signal, and who are planning for performance over the long haul, not just quick speculative wins.
Right. Acting early, analyzing deeply, planning long term.
Precisely. And maybe you have a final thought for you, the listener, to chew on. Think about how those investor strategies we discussed that focus on purpose-built rentals, on homes with basement suites, how might that shift change the actual mix of housing available in your neighborhood over the next year or two? It's not just about rates, it's about how different players react, and that shapes the market for everyone. Something to keep an eye on.